What is good, YouTube? It is your boy Sam, and I am back with another video. Okay, this is just the second video on the channel. If you haven't seen my first video, go check it out. I'm real excited. We're just gonna go off the top of the dome. I was not planning on making this video. I was just pretty much doing my setup here, and I liked how it turned out, and I figured might as well drop another banger. So that's kind of what we're doing here. As you can see, I got my @handle. It's pretty simple. Make sure you go follow that on Instagram and tap in with your boy, okay? So, in this video, we are going to be discussing options trading, okay? I know some of you may be familiar with that term. Some of you don't know what that is at all. That's okay, because in this video, I'm going to explain in the basicest way possible what options trading is. So that's the objective. If you don't get it by the end of the video, hopefully you get it. And later on down the line, we will get more into detail and make sure we get to that high level of options trading. But it's no pressure at all, right? This is just going to be a journey. So you know what you got to do? You got to make sure you like, comment, subscribe, and share this video. Let's create a community and tap in with your boy, and we will learn together. So I'm presenting myself to you guys as a student, not a teacher, okay? So we're all going to learn together, and I'm going to try to stay away from the textbook way of doing things, because that's where, fundamentals kind of get thrown out the window and it becomes boring. So let's just keep it interesting. So for my props, I'm going to be using napkins. This will be my only prop. Okay, so when it comes to options trading, not all companies that are traded on the stock market have options trading. So there are just a few. That's just a quick Google search away. You could Google search a list of stocks that have options and start from there and just kind of filter out the companies that you're not interested in. Pick a company that you're interested in. Make sure you monitor it over some time and just kind of understand how that stock moves, right? Not everything is just going to be indicators, parameters, and your Greek symbols, right? Looking at stocks is almost like speaking a language. You just got to make sure you understand it, know how it know how it changes in accordance with news or time, things of that nature. Okay, so I got my napkin here. This napkin is going to represent a stock option. Okay, and when I say stock option, we're going to call this a contract. So the contract gives an investor the right to purchase a stock at a particular price, even though the stock is no longer at that price, or sell the stock at a particular price, even if the stock is no longer at that price. Now, when I say a stock, I really mean 100 shares, because one contract controls 100 shares, and that is universal. That goes for all options trading. Okay, so if you hear someone, they're trading options and 200 shares are involved, that just means it's two contracts, essentially, right? So I'm gonna give you guys two different scenarios, right? One scenario, the stock is gonna go up and you're gonna capitalize off of the stock going up by trading options. The other scenario is you're gonna capitalize off of the stock going down, trading options as well, right? So if you're bullish, which means you believe the stock is gonna go up, that will be a call option that you will do, and I'll explain that shortly. And if you're bearish, which you believe the stock is going to go down, that is going to be a put option. Okay, you guys got that? And guys, don't hesitate to pause the video, rewind the video, watch the video 10 more times. Okay, just because you watch the video one time doesn't necessarily mean you are expected to retain all the information, because some of this is going to sound a lot foreign to you. So you might show it to somebody else and they might pick it up like this. If you do not pick it up like this, that is perfectly fine. Watch this video 100 times. And I'm not just trying to rack up on views. That's just how learning goes, right? So when you're reading a book, right, you may be a really good reader, but that doesn't mean you just read the book one time and you put it down. You can read the book multiple times, right? So back to my example. Let's use Apple for an example, okay? Let's say you want to do options trading off of the company Apple, and you believe the stock is going to go up and you want to capitalize off of that. For educational purposes, let's say Apple is trading at $100 a share right now. Let's say it's Monday. It's Monday. Apple is trading at $100 a share, And by Friday, this coming Friday, you believe Apple will be trading at $150 a share. These are extreme examples, but I just want you guys to understand the concept. So we're going to use basic numbers and just make it more fundamental, right? With that being said, um, options trading is also a good uh, trading strategy to where you don't have that much capital and you want a higher reward, which also means a bigger risk, right? So that's one good thing about option trading. When you purchase options, right, it's a high risk that your options might expire with no value at all, or you can, three times, four times your money in a small amount of time. So it's just a lot of leverage, okay? So back to the call option. So you believe Apple is going to go to $150, so that will be what you call your strike price. That is your goal, okay? That is your strike price. So what you do is you purchase the contract. You purchase the right. Doesn't mean you're purchasing the shares. You're purchasing the right, okay? You're purchasing the right to essentially go back in time, let's say on Friday, if you exercise the option to go back in time, purchase the stock at $100 a share and sell it at $150 a share, or just hang on to it at $150 a share, even though the stock is no longer at $100. Now, you as the options trader, that's not necessarily what you're doing. You're just purchasing the right to do that, and you're selling it to someone else who will exercise that option, right? So you are putting risk. You are putting your money on the line for that right. And as the stock goes towards the strike price or towards your goal price, the value of your option then goes up as well. So, for example, let's go back. It's Monday. Apple is trading at $100 a share. You believe that Apple would be at $150 a share by Friday, which is also the expiration date of that option you chose. So, for those of you that don't know, these contracts have expiration dates if you haven't caught on, okay? It doesn't have to be Friday specifically, but there are different expiration dates. But for the purpose of this example, this Friday is the expiration date for this contract that you're about to purchase on Monday. You buy it for, let's say, $10, okay? You buy this for $10. As the week progresses and Apple shares go from $100 to $102 to $105 to $108 to $120, and it works its way towards $150, the probability of it being $150, the Apple shares being $150 by Friday is higher, and therefore the option, okay, to go back in time and purchase the stock at $100 and execute it at whatever price, let's say $150, is more likely. Now, your option that was worth $10 initially is worth $20, is worth $30, is worth $40, and it literally doubles and quadruples, that quick, that easily, as you approach your expiration date and the stock is moving towards to your goal price, towards to that strike price. Now, what you're going to do is you're going to now sell it to another options trader prior to expiration date, right? So let's say expiration is Friday at 4 p.m. You might trade it at Friday at 11 a.m., for example. Doesn't necessarily mean you have to wait till the expiration date. You just have to sell it before the expiration time on that date, which is 4 p.m., or it's expired. It's useless, even though your prediction was correct. If you did nothing with this and you hung on to it, it will expire, and things that are expired are worthless, right? So essentially, you sell it to another options buyer who maybe discovered it at a later time. Let's say they discovered it Friday morning at 11 a.m. Now this is worth $40, right? Let's say Apple is trading at $130 Friday at 11 a.m., approaching $150. That other investor might look at that and say, wow, I think this is going to hit $150, and he might purchase it from you, the option, for $40. Don't forget you initially bought it at $10. So now you just made, a $20 profit, right? Or a $30 profit if you're buying it if you bought it at $10 and you're selling it at $40. Okay, so just keep in mind it doesn't actually have to hit your strike price. As it works towards that, the value of your option goes up. Okay, and if it does hit that strike price, you can expect the value of this option to be a lot more because now Apple is above $150, right? You're giving the person who may want to exercise this the option to go back and purchase 100 shares at $100 and execute and sell it or hang on to it, even if it's at $150 or $160, right? Which gives you, money. Now, the same works if you believe the stock is going to go down and you make a play predicting that the stock is going to go down, which means you're bearish. That is called a put option as opposed to a call option.